right now, as we watch the live ticker, Datavault AI Inc., trading under the symbol DVLT on the NASDAQ, is changing hands at exactly $2.13. The intraday action shows a downward slide, with the stock currently down 0.08 cents, representing a decline of approximately 3.62% for the session. If you're watching the charts on your Fidelity mobile app or tracking the tick-by-tick data on an interactive broker's trading screen, you are seeing a stock that is struggling to find its footing intraday despite a news cycle that, on the surface, sounds incredibly bullish. And this is exactly where we need to pause, because if you simply read the headlines, you would expect this stock to be flying. Instead, it is bleeding. There is a profound disconnect happening right now between the expectation retail investors have for a company with AI in its name and Bitcoin on its balance sheet and the cold hard reality of share structure mechanics. The expectation is that Datavault AI is a vertically integrated powerhouse combining the two hottest sectors in the market, artificial intelligence and cryptocurrency. The narrative floating around on social media forums and investment help boards is that this is an easy multi-bagger. However, the reality, which we are going to tear apart in this analysis, is far more complex and involves a massive dilution event that the market is currently trying to digest. When you see a stock price of $2.13 down nearly 4%, your first instinct might be to ask, is this a discount? Is this a buying opportunity for a stock that has recently raised its forward guidance significantly? To answer that, we have to look at why the stock is down today. It is not because the business model failed overnight. It is not because the AI sector is suddenly unpopular. After all, if you look at NVIDIA stock, or even the broader semiconductor indices, the appetite for compute and data is still there. The reason DVLT is heavy today has to do with the structure of its recent financing. Let's look at the volume. The trading volume today is active, but it feels heavy. There is a supply overhang. This is often what happens when a company issues what are called pre-funded warrants or significant equity tranches to a strategic partner. In this case, the partner is Silex Holding Company. The market knows that a massive amount of new shares, potentially hundreds of millions, have been authorized. When you have that kind of potential supply hitting the market, or even just the threat of it hitting the market, it acts like a wet blanket on the stock price. It doesn't matter if the company just received over 1,000 Bitcoin. If the share count balloons, the value per share gets diluted. That is the tension we're seeing at $2.13. The company is getting richer in assets, but the slice of the pie for existing shareholders is getting thinner. To understand this movement, you have to think about who is trading this. This isn't a stock usually found in conservative Schwab Intelligent portfolios or low-risk Fidelity mutual funds. This is a battleground for high-frequency traders and aggressive retail speculation. If you are using a Robinhood app or a SoFi active investing account, you are likely seeing extreme volatility warnings. That is because the float, the number of shares available for public trading, is undergoing a structural shift. The smart money, likely operating through institutional desks or sophisticated interactive brokers accounts, is doing the math on the fully diluted market cap, not just the basic market cap you see on a free finance website. Let's strip away the noise and look at the company itself, because if you can look past the dilution, there is a fascinating, albeit high-risk, business pivot happening here. Datavault AI was not always an AI play. For a long time, investors knew this entity largely through its connection to WiSA and high-end audio technology. The shift to Datavault AI is a massive strategic pivot. They are moving from hardware and sound into the nebulous but potentially lucrative world of data monetization and real-world asset tokenization. The core thesis they are pitching to you is that data is the new oil and they have the refinery. They are building platforms that allow companies to value their data, tokenizing it, and then monetizing it on the blockchain. This is why you see buzzwords like Web 3.0 and AI-driven valuation in their press releases. But unlike many companies that just use the words, Datavault is signing deals that are actually putting assets on the books. Take the recent deal with Triton Geothermal. This is a concrete example of what they're trying to do. They aren't just selling software, they are tokenizing the value of geothermal energy assets. The idea is to take a physical asset, energy, and create a digital financial product around it using their AI and blockchain tech. If it works, it generates high-margin licensing fees. If it doesn't, it's a science project. But the market is looking at the Silex deal even more closely. Silex, a biotech company, invested $150 million into Datavault, paid in Bitcoin. This is incredibly rare. You rarely see a biotech firm buying a huge stake in an AI data firm using cryptocurrency. It sounds like financial fiction, but it is real, and it has put roughly 1,200 Bitcoin onto Datavault's balance sheet. This brings us back to the price of $2.13. If the company holds that much Bitcoin, shouldn't the floor be higher? This is where the expectation versus reality dynamic hits you again. The market is discounting that Bitcoin because the market fears the operational burn rate. A company that is pivoting requires massive capital. They need to pay developers, they need to build out their data quarterback platform, and they need to market these services. The fear is that the Bitcoin will be sold to fund operations rather than sitting there as a pristine reserve asset like it does for some other famous tech proxies. Furthermore, we need to discuss the meme coin dividend. Yes, you heard that right. Datavault has discussed distributing a Dream Bowl 2026 meme coin to shareholders. For a serious institutional investor looking for Fidelity Wealth Management quality assets, this sounds like a red flag. It sounds gimmicky. But for the modern retail trader on Robinhood Crypto or looking for high-risk plays on SoFi Invest, this is catnip. It creates viral marketing. It keeps the ticker trending. It is a modern tactic for a modern market, but it introduces massive volatility. It attracts a shareholder base that is less concerned with earnings per share and more concerned with momentum and hype cycles. Let's look deeper into the chart dynamics we are seeing today. At $2.13, we are hovering near a psychological support zone. The $2 level is critical. If you look at the order book, which you can see clearly if you have level 2 data on an interactive brokers trading platform or a similar pro tool, you will likely see a buy wall stacked right around $2. Traders are betting that the company will defend this price. However, if it cracks $2, the stop losses from retail traders using the Robinhood app will trigger. When those stops hit, it causes a cascade. This is why the 3.62% drop we are seeing right now is dangerous. It is inching closer to that capitulation point. On the flip side, the resistance is clear. Every time the stock pops toward $2.50, it gets sold. Why? Because there are likely warrant holders or early investors who are looking to de-risk. They see the liquidity provided by the recent news spikes as an exit door. This is classic sell the news behavior. The news was the Bitcoin deal. The news was the raised guidance. The reaction has been a fade. Speaking of guidance, we cannot ignore the numbers management has thrown out. They raised their fiscal year 2026 revenue guidance to over $200 million. Currently, the stock is trading at a valuation that, if they actually hit $200 million in revenue, would make $2.13 look remarkably cheap. A tech company growing that fast usually trades at a multiple of sales, often 5 to 10 times sales. If Datavault hits those numbers, the market cap should be significantly higher. But the market is skeptical. That is the reality right now. Skepticism. The market is saying, we don't believe you can scale from a few million in revenue to 200 million that quickly without a catch. The catch is usually execution risk. This is a great moment to pause and ask yourself, what is your actual strategy here? Are you a trader or an investor? If you are an investor looking for stable long-term growth, you usually stick to things like Apple stock or Tesla stock, companies with proven product loops. Or perhaps you use automated tools like Schwab Intelligent Portfolios to avoid picking individual winners. But if you are in DVLT, you are speculating on a turnaround and a breakout. You are betting that the data economy is real and that this specific company has the IP to capture it. I want you to take a second and comment below. Seriously, I want to know the sentiment on this. How many shares of Datavault AI, DVLT, are you currently holding, and what is your average cost basis? Are you underwater at these levels, or did you get in early before the pivot? And do you think the Bitcoin on their balance sheet is a safety net or a distraction? Let me